Well, hello there. This is Brantley Whitley with my co-host Brandon Roberts here on the Insurance Pro Blog Facebook page. It's a little dark today in my studio, and so I'm, it's pretty rare. I would say that there's a day that's darker in Georgia than it is in Vermont in the middle of winter, but somehow we've managed to pull it off. Brandon, you look like you were on the edge of your seat waiting to say something. So,
modified endowment contracts.
in other words, he's delivering on what I should have done, which is before I went on rambling. So today we're back with our 7th broadcast, and today is all about sevens. Really, it's all about modified endowment contracts. If you know anything about modified endowment contracts, you'll understand why the number 7 is significant, and Brandon will get into that in just a second. But first, I'd like to mention that if you like these and you would like to support us, we would greatly appreciate that. You can go over to ipblive.com. That is insuranceproblog.live.com, except it's ipblive.com. And over there, you'll learn all about our book, Predictable Profits, which is not just a book. It is a book that you will receive in the mail, which I should have had my prop ready to go here. But you'll also get some other great bonuses, a live case study recording that we did. Just go over to ipblive.com and read all about it. All right, Brandon. So modified endowment contracts, that's what we're talking about.
It is. We're talking about something very specific to the modified endowment contract. And it's kind of a phenomenon that agents notice about the MEC, and kind of a head-scratching moment as they start to wander from introductory understanding to more advanced understanding of the modified endowment contract. And so most agents learn that the modified endowment contract is effectively a test that says the premiums that go into a life insurance policy cannot exceed the amount that would be necessary to make the policy paid up prior than the 7th policy year.
Okay. All right.
And so that sort of alludes to the fact that, okay, as long as the premiums aren't sufficient enough to make a paid up policy, or as long as the policy is not paid up prior to year 7, we're fine.
Right.
And after that, we can do whatever we want. Unfortunately, that's not true. And there is a lot of situations where policies will violate the modified endowment contract test after the 7th year. And that causes a number of questions about the rudimentary understanding that a lot of people might have concerning the modified endowment. What's happening is the first 7 years absolutely matter. But after the 7th year, the modified endowment contract clock, so to speak, can be reset due to a material change. Material changes are kind of loosely identified under the tax code, but they do include things like a death benefit increase, a change of the insured under the policy if this is a business planning case, or the addition or enhancement of a rider. So if you rider or you enhance the benefits of a rider.
Okay.
Any of those things are a material change, and what material changes do, per the modified endowment contract law, is they reestablish a new 7-year period.
Okay. So the clock starts over.
Yes, it starts over with kind of a new basis based on the death benefit that's prevailing at the time, and a new maximum premium that can be put into the policy in order to not create a guaranteed paid up product within 7 years.
Right.
So it's possible that a certain amount of premium could violate the modified endowment contract at that time. It's also possible that a reduction in the death benefit could cause a MEC violation at that time.
Right.
Reduction in death benefit is kind of an interesting aspect to the MEC test, in the sense that it forces a look back testing that takes place.
Mm.
What I mean by that is whenever there is a running 7-year clock and there is a reduction in the death benefit of a policy, the new prevailing death benefit cannot have violated the MEC test for whatever the last preceding years of the progression of the MEC test is. That's
That's a mouthful.
technically a correct way of saying it, but I'm sure no one knows what I just said. So let's use an example, and let's say that you've caused a material change as of 5 years ago. You're currently placing premium into a whole life insurance policy, and you decide that you're going to make the policy reduce paid up at this point.
Right.
So that is going to cause a reduction in death benefit. And you've been paying, just for this example, $20,000 of premium to this policy now, for at least the past 5 years, probably since inception.
Right.
And when you reduce the death benefit, the MEC calculation now requires the insurance company to verify that at no point in the last 5 years would a $20,000 premium have violated the MEC test. So if the calculated premiums that would be annually paid exceed $20,000 per the MEC limitation, you will have violated the MEC test at that point.
Right.
Even though you didn't violate it under the old higher death benefit amount, the new lower one causes a retest, reclassification. And so if any of those prior 5 payments now violate the new prevailing death benefit for the MEC calculation, you will have violated the MEC test.
Right. So in other words, just the act of reducing the death benefit in that case could trigger a MEC violation.
Correct.
Right.
So for the agents who notice that running a reduced paid up scenario inside company illustration software, it's happening at like year 30. And why is this? Why? That is the reason, because there was a material change that took place. And oftentimes the material change that happens that agents don't think about is the use of paid up additions. They increase death benefit. And that causes an almost continuous material change on a lot of whole life insurance policies.
Right.
A rising death benefit on a universal life insurance policy could also make a material change. Now, I want to be very clear about pointing out a particular nuance for people, because we mentioned that anytime a material change takes place, the MEC calculation resets, and that creates a scenario where a reduction in death benefit could cause a problem. And that reduction in death benefit could be a reduced paid up. It could also be the removal of a term insurance rider.
Right.
So the reduction of death benefit, it matters so long as we have an actively running 7-year test.
Yep.
If we've not caused a material change since the end of the original 7 years, we can reduce the death benefit, and we're not worried about a violation of MEC compliance, because there's not a currently running 7-year clock, unless the policy is a second to die policy. All second to die policies will recalculate and recheck for MEC compliance regardless of when the last MEC calculation started. That's a nuance to second to die policies. So they introduce an additional layer of complexity when it comes to manipulating death benefit after the policy's been issued and remaining compliant with the modified endowment contract test. Okay.
Well, one of the things that causes some confusion, I believe, and I think, for a lot of years, I was unclear about this, is the 7-year sort of time frame, which you've mentioned numerous times, obviously, but there seems to be this sort of prevailing misinformation in our industry that the only 7 years you really need to worry about are the first 7 years.
Correct. And I know that is a misunderstanding.
Right. And what's worse for everyone, I think, is that, and this gets more into the fundamental understandings of modified endowment contracts in general, but it's worth bringing up. And that is that what constitutes violations tends to be subject to interpretation.
In some cases, yes. Some insurers interpret the law differently.
Right. So we've had some discussions there, and there's just not a lot of consistency there. I mean, there are certain things that are very obvious that create a MEC. And look, here's the other thing that we also learn as agents. The second thing I wanted to bring up, as agents, at least I was taught that MEC equals bad. That MECs are that modified endowment contracts are undesirable things, and that we definitely don't want to do that. And I would agree that if it's a situation where someone does not realize they are creating modified endowment contract and doesn't understand, some of the limitations that come along with having a modified endowment contract, that is definitely a bad thing. But there are situations, which we're not going to get into today, that's beyond the scope of what we're doing, but there are situations where it's not necessarily a bad thing.
Yep.
So
there are cases where it doesn't matter. It's immaterial.
Yeah. But we've also come in full circle. We've also seen some situations where opinions that were given by insurance companies were not consistent with the way we would read the regulations about what constitutes a modified endowment contract.
Yep. There was a time when at least one insurer I can think of assumed, just as a lot of agents do, that after 7 years it doesn't matter, which is incorrect.
Right.
I think they've since evolved on that, but
I would hope
there was a time.
Yeah.
I think the last thing I want to mention, because it's important for this discussion and ongoing modified endowment contract discussions, the law that brought modified endowment contracts into place, the Technical and Miscellaneous Revenue Act of 1988, sometimes we refer to it as Tamra. It established MECs, but it also left a contingency for policies that were currently in existence to say that those policies will not be affected by these new rules.
Right.
So any policy, any life insurance policy, universal life insurance, whole life insurance, that was put in place prior to June 21st of 1988 plays by a different set of rules. And it doesn't have to worry about this quite as intently, but it still can be affected by this law, and it can still turn into a modified endowment contract. It's just that the scenarios that can do that are fewer.
Right.
The big things are any sort of increase in death benefit or enhancement of feature, like a rider, that requires insurance company underwriting approval. So if you were to take one of those old policies, again, prior to June 21st, 1988, and you were to increase the death benefit or add a rider that required underwriting approval, you now subject that policy to most of the rules associated with modified endowment contracts. And now moving forward, premiums have to comply. So I throw that out there only to point out that if you were to stumble upon a policy like that, oftentimes it's best to approach it with an extreme amount of caution about what happens to it, because there's certain things you don't want to necessarily do due to the fact that it plays by a different set of rules.
Absolutely. Okay. Anything else to add?
I think we got everything we needed to do.
Have we flogged the modified endowment contract horse as much as we need to?
At least today.
Okay. Well, we hope that you guys will come back tomorrow. Hopefully we'll get the technology.
Hopefully it'll be a little brighter tomorrow.
Hopefully there'll be a little sunshine tomorrow, and technology won't give me problems tomorrow. In the meantime, head on over to ipblive.com to check out more from our book, Predictable Profits. Find out more about it and see if it's something you might be interested in. Until tomorrow, see you later.